What if I told you there is a single investment that has quietly turned everyday people into millionaires? Not through luck, not through insider knowledge, but simply by holding on decade after decade. This investment isn't hidden. It isn't complicated. And Warren Buffett himself says it's the best choice for most investors. It's called the S&P 500. What is the S&P 500? The S&P 500 is not a single stock. It's an index, a collection of the 500 largest publicly traded companies in the United States. When you invest in the S&P 500, you automatically own a small piece of Apple, Microsoft, Amazon, Google, Tesla, Coca-Cola, Johnson & Johnson, and hundreds more. You don't need to guess which company will dominate the future, because the index updates itself. When weak companies fall out, stronger ones take their place. This means you're always invested in the top performers of the American economy. Why it matters. Think of it this way. If you put all your money in one company, you might get lucky, or you might lose everything. But when you put your money in the S&P 500, you're spreading your bet across every major sector of the economy: technology, healthcare, energy, consumer goods, finance. It's like having a built-in safety net. One company may fail, but the economy as a whole continues to grow. That's why long-term, the S&P 500 has been one of the most reliable paths to wealth in history. Historical performance. Now let's look at the numbers. The S&P 500 was launched in 1957. Since then, it has delivered an average annual return of about 10%. That's not 10% every year. Some years, it drops 30%, like in the financial crisis of 2008. Some years, it surges 25 or 30%. But over the long term, the average smooths out to roughly 10% a year. Consider this. In the 1970s, the U.S. faced oil shocks and stagflation. The market suffered, but recovered. In the early 2000s, the dot-com bubble burst. Tech stocks crashed. But the index came back stronger. In 2008, the great financial crisis wiped out trillions. Yet, from 2009 to 2019, the S&P more than tripled. Even during the pandemic crash of 2020, when markets fell 30% in weeks, the S&P 500 not only recovered but reached all-time highs soon after. This pattern repeats: crash, recovery, growth. Over the decades, the direction is always upward. The power of compounding. Here's where the magic happens. Compounding. Imagine planting a tree. In the first year, it's small. In the second year, it grows a little more. But eventually, it produces seeds, and those seeds grow into new trees. Over decades, you don't just have one tree. You have an entire forest. That's how compounding works with money. Let's take an example. If you invested $1,000 in the S&P 500 in 1980, today it would be worth over $100,000. Now imagine investing $10,000. That would have grown into more than $1 million. And remember, this isn't guessing the right stock. It's simply buying the index and waiting. Why it's beneficial. So why do so many investors recommend the S&P 500? Diversification. You instantly own parts of 500 companies. Accessibility. With ETFs like SPY or VOO, anyone can start with just a few dollars. Low cost. Index funds have very low fees compared to mutual funds. Passivity. You don't need to spend hours researching. The index adjusts automatically. Proven track record. Decades of data show steady, long-term growth. Practical examples. Let's get concrete. Example 1. Lump sum. If you had invested $10,000 into the S&P 500 in 1990, today it would be worth around $200,000. Example 2. Monthly investing. If you invest $500 every month for 30 years at a 10% return, you'll end up with nearly $1 million. Example 3. Starting small. Even $100 a month invested consistently becomes nearly $200,000 in 30 years. The lesson is clear. It's not about timing the market. It's about time in the market. Buffett's advice. Warren Buffett once made a famous bet. In 2007, he challenged hedge fund managers to a 10-year contest. His choice? A simple S&P 500 index fund. Their choice? Actively managed hedge funds. After 10 years, the result was clear. The S&P 500 crushed the hedge funds. Buffett's point was simple. Most people will do better by simply buying the index and holding on. The lesson, the S&P 500 is not flashy. It doesn't promise overnight riches, but it is consistent. Think of it as a train. It may be slow at times. It may face delays, but it always moves forward. Every dollar you invest is a ticket on that train. Every month you wait is a train car leaving without you. Conclusion, the S&P 500 is not a get-rich-quick scheme. It's a get-rich-for-sure strategy. Slow. Steady. Proven. If you want to give your future self the gift of financial freedom, this is one of the simplest and safest ways to do it. So, let me ask you, if you had $1,000 today, would you invest it in the S&P 500? Comment below and share your answer. Intro hook. Imagine turning just $1,000 into over $100,000 without picking a single stock. This isn't a myth. It's not a secret locked away on Wall Street. It's something you can invest in today from your phone in just a few clicks. It's called the S&P 500. What is the S&P 500? The S&P 500 is an index. It tracks the performance of the 500 largest publicly traded companies in the United States. Think Apple, Microsoft, Google, Amazon, Tesla, Coca-Cola, and hundreds more. When you invest in the S&P 500, you're not betting on a single company's success or failure. You're betting on the strength of the American economy itself. It's like owning a slice of the entire U.S. corporate world. Why it matters? Why is this important? Because individual companies rise and fall. Some disappear entirely. But the U.S. economy as a whole has grown stronger decade after decade. The S&P 500 reflects that growth. Instead of trying to guess which single company will dominate the future, the index adjusts for you. When weaker companies fall out, stronger ones take their place. That means the S&P 500 always represents the leaders of the economy. Historical performance. Let's talk about results. The S&P 500 was created in 1957. Since then, its average annual return has been about 10%. That might not sound exciting at first, but here's why it matters. Even with recessions, wars, oil shocks, dot-com bubbles, financial crises, and pandemics, the index always bounced back and kept moving higher. The long-term trend is clear, upward. The power of compounding. Here's the magic, compounding. If you had invested just $1,000 in the S&P 500 in 1980, by today that money would have grown to over $100,000. Not because of luck. Not because of insider tips. But because of time and the snowball effect of compound returns. Albert Einstein called compounding the eighth wonder of the world. And the S&P 500 is one of the clearest ways to harness it. Why it's beneficial? So why do so many investors recommend the S&P 500? Let's break it down. Diversification. You're instantly spread across 500 different companies in multiple industries. Accessibility. Through ETFs like SPI or VOO, you can invest with as little as $50 or $100. Passivity. You don't need to study balance sheets or chase hot stocks. The index does the work. Evolution. Weak companies drop out. Stronger, newer companies enter. The index constantly refreshes itself. It's like having a portfolio that automatically updates to always hold the biggest winners. Practical example, let's look at a real-world example. If you invest $500 per month in the S&P 500 and you continue for 30 years at a 10% average return, you'll end up with close to $1 million. $500 a month. That's the price of eating out less, skipping luxury purchases or cutting unnecessary expenses. And in exchange, you buy yourself financial freedom. That's the true power of the S&P 500. Buffett's advice. Warren Buffett, one of the richest men alive, has been very clear. He says, for most people, the best thing you can do is put your money in an S&P 500 index fund and forget about it. This is a billionaire telling us not to gamble, not to chase hot stocks, but to keep it simple. Why? Because simplicity works. The lesson. So here's the lesson. The S&P 500 is not glamorous. It doesn't make headlines like meme stocks or crypto pumps. But it's safe, steady, and proven.
If wealth is a train, the S&P 500 is the track.
Every month you invest, you're adding fuel to your engine. Every month you delay, you're letting another train car leave without you. Conclusion. The S&P 500 is not a get-rich-quick scheme. It is a get-rich-for-sure plan. Slow, steady, reliable. If you want the closest thing to guaranteed prosperity in investing, this is it. So let me ask you, if you had $1,000 today, would you invest it in the S&P 500? Comment below and share your answer.